Hey everyone, welcome back to Finance Friday. It's another special edition of Money Girl where I answer your burning money questions. Today's topic comes from Joel H., who says, "Love the show, so much good advice. I just learned about a home equity investment where you receive a portion of your home equity with no monthly payments. I'm 59 and a half and my wife is 51. We have a sizable amount of equity, 75% of a $2.8 million home, and I've been told we could get a home equity investment loan for up to $500,000. I don't need the funds now, but I think it could be a way to help me retire early." While we do have about $3 million in retirement funds, we live in the Bay Area and still have teenagers in school, so it's not enough for us to retire yet. Is getting a home equity investment loan too good to be true? Thank you for your great question, Joel. I'll review the pros and cons of getting a home equity investment loan and how it differs from some other options to tap the value of your home. I appreciate you downloading episode 927 of the Money Girl podcast. I'm your host, Laura Adams. I'm an award-winning author. I'm a speaker, an on-camera spokesperson, and founder of The Money Stack. That's my Substack newsletter. I'd love you to be a part of that. You can subscribe for free, or you can become a paid Substack member and get access to live educational events. You can learn more and connect with me at lauradadams.com. That's also where you can sign up for The Money Stack. You can also record a brief question or comment by calling our voicemail at 302-364-0308. I look forward to hearing from you. This is a great question that I've never had come up before. And you've probably heard of a home equity line of credit, or HELOC, or a home equity loan, which allows you to borrow against your home equity. Now, equity is the difference between your home's current value and any debt you owe, like a first or second mortgage. For instance, if your home is worth $500,000 and you owe $400,000, you have $100,000 of equity. Now, with a home equity investment, or HEI, it's a different product. It's also known as a home equity sharing agreement. It's actually a contract that you make with an investment company that allows you to receive an upfront payment in exchange for a portion of your home's future appreciation or its future value. So with a home equity investment, you actually sell a stake in your home's future value, and the investor shares your home's potential appreciation or potential depreciation. And if your property value increases significantly, you may pay the investor more over the long run than with a traditional loan like a home equity loan or a HELOC. But unlike a traditional loan where you make monthly payments that include interest, with an HEI, there are no payments. Instead, you agree to repay the original loan amount plus a share of your home's value at a later date. Here's an example. Let's say if you repay the home equity investment within 5 years, you might have to pay 15% of your home's value, or 20% if you repay the investment after 10 years. So let's say your $500,000 home is worth $600,000 after 5 years and $700,000 after 10 years of taking the home equity investment. Well, in this example, if you settled up after 5 years, you'd owe the principal amount that you borrowed plus 15% of $600,000 or $90,000. And if you settled after 10 years, you'd owe the principal plus 20% of $700,000 or $140,000. Now, if your home depreciates, if the value goes down, you still must pay a set percentage of your home's value, such as 15%. And every home equity investment is going to be different, but this is just an example to kind of illustrate, what the fees could look like. Some home equity investments have a set expiration date for repayment, while others must be repaid when you sell or refinance your home. So again, the terms are going to be a little different depending on the investor. So let's talk about the main pros for taking a home equity investment loan. I think the first benefit is that you don't make monthly payments. Not worrying about making payments could be a lifesaver if you're experiencing a financial hardship or you need more monthly cash flow. You owe nothing for an HEI until the term expires or you decide to sell or refinance your home. Another benefit is that you don't need good finances to get one. Since a home equity investment is an investment in your home, you may qualify even if you have no or low income, or even if you have poor credit or a high level of debt. Another benefit is that you can tap a large amount of equity. Depending on your home value and equity, some HEIs may pay up to $500,000, as Joel mentioned in his question. Another benefit, you can use the funds any way you wish. You can save HEI funds or spend them on anything you like. It could be living expenses, medical bills, home renovations, education, or a vacation. And lastly, you have an extended repayment term. Different HEI companies offer different terms, and they might range from 10 to 30 years and typically have no prepayment penalties. All right, let's talk about the cons of a home equity investment loan. Joel asked if getting an HEI is too good to be true. Well, there are certainly downsides to consider. First, you are going to have to share a significant portion of your home's price or its appreciation. In exchange for getting that lump sum of cash from an investor, you agree to share a hefty portion of your home's future value or its future appreciation, no matter if the value goes up or down. As I said, different HEI companies have different calculations and fee schedules, so you want to be sure you understand them. Another downside is that you may not get funds quickly. Since your home secures a home equity investment, the investor will require an appraisal and perhaps other documentation. So that means it could take longer than if you applied for a traditional loan like an unsecured personal loan. Your property may not qualify. HEIs may not be available in your state or for your type of property. And another downside is that you risk foreclosure. Just like a loan secured by your home, if you don't repay an HEI at the end of the term, you risk losing your home to foreclosure. And another downside is that your future cost is uncertain. Unlike a fixed-rate loan, with a home equity investment, you won't know what you owe the investors until you're ready to repay and you know the value of your home. However, some companies do include caps that prevent you from repaying too much if your home appreciates significantly. So, should you get a home equity investment loan? Well, since Joel doesn't sound like he's experiencing financial hardship, I don't recommend that he get a home equity investment loan. I think there are less expensive ways that he can tap his home equity when he needs to. For instance, if he took out a home equity line of credit or HELOC, that would give him the ability to tap his equity without sharing a large chunk of his home's future value or future appreciation. While a HELOC does come with interest and closing costs, it would likely add up to be lower than the cost of an HEI. The going interest rate on a HELOC is about 6 to 7% right now. But as I mentioned, that's one of the downsides with an HEI. You don't really know what you're going to owe because nobody knows whether values on real estate will go up or down. With a HELOC, you can tap any amount of your equity up to your available limit. And that could give Joel a nice safety net if he does decide to retire early. Another option for Joel is to wait until age 62 and get a reverse mortgage. That allows you to take a loan or a line of credit based on your home's equity once you've reached the age of 62. Now, like an HEI, you don't make monthly payments on a reverse mortgage. However, you don't have to share any of your home's future equity. A reverse mortgage must be repaid with interest when you move out, you sell, or you refinance your home. A home equity investment loan is primarily a good fit when you need to tap a large amount of your home's equity, but you can't get traditional financing because you've got low income, high debt, or poor credit. Since the future cost of an HEI is unknown or likely to be more expensive than other options, it's probably not right for Joel. If you're thinking about tapping your home equity, definitely do your homework to compare the cost of various options, including getting a home equity loan or a home equity line of credit, refinancing, taking out a reverse mortgage if you're over 62, or agreeing to a home equity investment. No matter your situation, always try to borrow money for the lowest total cost possible. The best money move depends on your home value, your equity, your finances, and your goals. Remember that if you plan to use borrowed funds to buy, build, or remodel a home, interest paid on up to a certain amount of a home equity loan or line of credit is tax deductible. So that could be definitely a way to save money if that's the way you plan to spend those funds. Joel, I really appreciate your question and agree that your considerable home equity can be part of your retirement planning. Carefully compare your options for tapping it and consider getting advice from a certified financial planner. They may have additional ideas for creating a financial safety net and income if you want an early retirement. Before we go, a quick reminder to subscribe to The Money Stack. That's my Substack newsletter when you visit lauradadams.com. It's filled with money tips, tools, news, challenges, and things I enjoy. You can subscribe for free or support the show as a paid member with access to live educational events. That's all for now. I'll talk to you soon. Until then, here's to living a richer life. Money Girl is a quick and dirty tips podcast, and we've got a great team that works on the show. Steve Rickyberg audio engineers the podcast. Brandon Gachus is our director of podcast. Holly Hutchins is our digital operations specialist. Morgan Christensen is our advertising operations specialist. And Nathaniel Hoops is our marketing contractor.